I'm creating this video for people that are looking to get into commercial banking or are perhaps very new to their commercial banking career and wanting to look into, what everything means in commercial banking, learning about deals, learning about, capital markets, learning about, different types of term debt, revolving credit facilities, treasury management, anything like that. And so I'm kind of creating this so you can kind of get a basic intro of what everything means. And maybe I'll revise this later so that there's even more information, but this will be a great starting point for anyone looking to get into commercial banking. So first off, what is commercial banking? Commercial banking is the business of providing a suite of, basic banking products to, companies that are in your geographic territory or in any territory for that matter. Commercial banking is generally associated with banking middle market companies. So that would be dependent on banks. Some banks will categorize it different than others. I think JP Morgan categorizes it up all the way to $2 billion, but let's just stick with a very wide threshold of 20 million to $1 billion. Those are going to be your general companies, and probably 500 million and up are going to start getting involved in syndicated credit facilities. But below that, you're going to be the only bank dealing with that client outside if they keep, maybe some deposits at another bank that they like to work with or have as a backup. But there's a wide range of products. Some of these products are deposits based products such as money market accounts. Then there's treasury management products and capital market products. And then outside of commercial banking, there's business banking, which is between 5 million to 20 million. Some banks, like I think Wells does currently, although Wells has reorganized 20 different times by this point, houses business banking with their commercial banking group. And then there's corporate banking, which is dealing with companies that do billions in revenue and are almost always syndicated deals, and they're just, giant companies. Moving on to relationship managers. Relationship managers are the people that are dealing with these companies day in, day out. They are the sales force for the bank generally. Some banks do have BDO positions, business development officers, where they just leave the relationship managers to handling the existing relationships for the bank. However, that's, atypical. Most relationship managers are handling the exact relationship with the bank. Relationship managers generally start as credit analysts, and they spend their 1 to 5 years in credit and will eventually move into becoming full relationship managers, and then group heads, and then market heads, and so on down their career. But I would like to elevate to a lot of people that what I've noticed in commercial banking is that relationship managers, it's very relevant to be a relationship manager in your career. It's kind of hard to spend your entire life on the credit side and move up. And I don't know if that's the correct way we should be operating this industry, but that's the way it is. A lot of people that are market heads see that you need to do both sides to understand how a deal works. Because when you're in credit, your mindset is always, what's wrong with this deal? And what do I need to elevate to the credit administration so that they can have, an honest representation of it. So you never get the I should sell this deal to credit. I should sell this deal so that we can prove it. Your mindset is always, why should I shut this down? And that's not an appropriate mindset to have when you're trying to make a functional running organization. So generally in your career, you should always seek to be a relationship manager, maybe not for 20 years, but think 5 to 10 years in your career in commercial banking, you should seek to be a relationship manager. Relationship managers are, nurturing their existing clients, and they're often going to be selling them bigger loan facilities. Companies are going to grow every year. If not at the rate of GDP, they can grow even bigger than that because you're dealing with middle market companies. Traditionally, they have much more growth than large mature companies. Relationship managers, a lot of their day is cold calling, cold emailing, drop-ins, and that's like the bulk of their prospecting. But as they move later in their career, a lot of their deals are going to come from the referral networks because they're going to know 10 accountants, 10 attorneys, 10 insurance brokers, and they're gonna, be meeting with them on a monthly basis to, just ask basic probing questions like, hey, just want to connect. I was just wondering, can you think of anyone in your book of business that's looking for a loan? And you just are going to naturally be asking those probing questions to your existing relationships to potentially get more opportunities. Additionally, I've seen like a rise of going to trade shows. Trade shows have been excellent for finding potential clients because a lot of times the CEOs, CFOs are going to the trade shows to try to show the brand off. And you get an opportunity to be one banker out of thousands of industry representatives. And it really gives you the opportunity to reach out to C-level executives and not do so in such a way like a drop-in where you're just showing up to their place hoping they like you. I'm kind of against drop-ins, but it is a very common thing to do. But the products that you're going to be offering in commercial banking are lending, deposit-based products, treasury management, and capital markets. Lending, deposit-based products can generally be broken down between revolving credit facilities and term debt. Treasury management, since I'm not going to go over a ton of it, is anything that's credit cards, merchant services, fraud protection, or integrating your payables process. So corporate credit cards, everyone knows what a credit card is, but this is just one for your company. Then there's merchant services, which is like if you ever go to a store, JCPenney, a Kohl's, a McDonald's, wherever you're going, you're giving them your credit card, and that system that processes that credit card, that's merchant services. And then there's fraud protection products. We live in a world that's continually seeing more and more fraud, such as check fraud, which is really common. Your account and routing number is on your checks. And so people will open your mail hoping to find a check. And when they find that for a company, they'll, write a hot check and they'll have, $50,000 in their hands. And it's a big question where everything's going. So fraud protection products are there to, prevent potential theft against companies. And those are services which companies are obviously willing to pay for. It used to be that fraud protection products, if a company didn't buy it, they would just they would complain to the bank and be, hey, we didn't buy your fraud protection product, but we want our money back because we experienced fraud. And the bank would just refund the money because they're just wanting to preserve that existing relationship because it's profitable for the bank. However, that's beginning to change. It's now if you do not have a fraud product, we are going to, not going to pay you. And that is a really hard conversation to have with clients, but it is a necessary one to have. And then there's integrated payables and receivables. A lot of times you're wanting to automate the process of, your payables and receivables in a company, and banks are now coming out with fancy products to be able to automate that process and remove some of your back office, which is going to lower your operating expenditures and then going to increase the working capital in your business because it's going to, pay your bills at the last moment needed and collect your receivable as soon as possible. And then there's capital markets. Capital markets involve anything such as syndications, M&A advisory, foreign exchange services, interest rate hedging, debt capital markets, and equity capital markets. Those are a lot of big names, but that's like, what Wall Street loves and what any bank loves because they're so good for fee income. Just moving over to lines of credit. This is really your bread and butter of commercial banking. When I'm picking up a phone and talking to a prospect, I'm always asking, hey, when's your line of credit up for renewal? And would you like some, competition to keep your current bank honest? That's generally the pitch. And where you want to say, like, are you happy with your current bank? And, stuff like that. But we're always asking, what is your current line of credit? And are you looking for a new bank to potentially participate? There's a bunch of different, ways you can structure a line of credit, and often regional banks are going to win on that structure. But there's formulas and non-formula based lines of credit as your typical line of credit that you're thinking of. Non-formula line of credit is going to be your most typical type of line of credit. Non-formulas are, as it says, non-formula, we're just giving you $5 million and we have belief in your company, the creditworthiness, that we don't need to do any sort of fancy ABL to monitor the assets of your company. Opposed to a non-formula is a formula-based line of credit, which is also an ABL, which is we are advancing a specific amount of money against the assets in your company, which could be your receivables and your inventory. And as you acquire more inventory, you're going to have a larger ability to pull from the line of credit, and vice versa with receivables. The reason we're really doing a formula line of credit is because we don't want a shortfall in the outstanding debt and the underlying, collateral with that, credit facility. Which in simple terms is, we say that your assets that we're secured against are worth $10 million, which is, the secured against, which means we could go collect on them. And we don't want a situation where we have more than $10 million against that collateral. We don't want there to be a $2 million deficit where the bank could potentially get hurt for $2 million. We want to make it so that we have maximum collateral. So if anything does go south, we could just go in, take the inventory or collect on the accounts receivables so we can, in theory, get paid back by a secondary means of repayment. As I mentioned, structuring is where regional banks win. Big banks like JP Morgan and Wells Fargo are always going to win on pricing. They have ginormous balance sheets with, very little cost deposits where they can really just undercut everyone in the market. So where a regional bank is going to win, they're going to win in those higher, credit risk deals, and they're going to provide really competitive structure, such as, they could be securing the line of credit to real estate. They could be providing a line of credit which also has a sublimit for buying equipment and then turning that equipment into a term loan. They're really providing fancy facilities that aren't cookie cutter and are gonna really win relationships with owners of companies. And then pricing varies significantly between the risk and overall profitability of a deal. Additionally, with the bank, as I mentioned, because bigger banks are going to be able to offer cheaper pricing. But as a basic, if I'm pricing at SOFR plus 150, then I'm probably got a really profitable deal because I'm not paying a ton for deposits. Or if I'm pricing at SOFR plus 225, it's probably a fairly risky deal, and they have, a fairly competitive, money market account as well as we're maybe paying something on their checkings. So we're really trying to maximize the profitability of the relationship because, an unprofitable relationship is not good for the bank. And then let's go to term loans. There's a variety of term loans, but, just to name a few, you have real estate financing, equipment financing, and M&A financing. Amortization changes based on term loans, which is something that I didn't really think about when I went into banking, but there's terms and amortizations. So an equipment might be a 7/7, which is it's going to take 7 years to pay this off, and the term is 7 years, or I'm paying like it is 7 years and it is 7 years. Where opposed to real estate, I'm going to pay for only 7 years until I have to refinance, but I'm going to act like I'm paying 25 years. So at the end of the 7 years, there's going to be a big balloon payment. And the way I'm going to, deal with that is I'm either going to pay it all, which is unlikely, or I'm going to refinance the deal and put it on another 7-year loan. And additionally, a lot of these times with these real estate loans, they're not fixed. They're going to be swapped. Or they're going to be floating rate. So in order to fix them, we're going to, swap the deal, which is going to be a capital markets function. So we're often going to need to bring them in to fix the rate so that, you get a consistent payment. And in addition, there's P&I plus and then P plus I. P&I is what you traditionally think in a loan, which is that the rate's going to be, or the payment's going to be the same every payment. But P plus I is a bit different because the principal isn't adjusting. Like the principal is going to stay the flat rate. So your payments, when you start paying that loan down, or start paying that loan down are going to be much higher than at the end of the payment. And that's obviously more attractive for a bank. But if I'm a client, I'm obviously going to fight for P&I, although that may not be an opportunity depending on, multiple factors. And then there's M&A financing. M&A financing is a hot topic, and generally we're providing a term loan, and the collateral, if any, is severely limited. So that results in a fairly large airball, which is just a fancy way of saying a shortfall in assets compared to the amount of credit we're extending. So we could be giving them $10 million and we have zero collateral basically on that. Like we don't have anything. And so that could be fairly difficult to do. And the reason we're willing to do it a lot is because perhaps it's a sponsor back deal and the sponsor has dry powder, or left in their fund, and dry powder is just another way of saying they have cash or marketable securities in their fund. And so if anything does go bad with the investment, they're going to be able to back up the deal and make it so we as a bank don't get hurt, because we really, our upside's not big. We are, whatever, to a private equity client, what are we offering? Like SOFR plus 350, which is giant in our heads, but at the current market rates, that's 5.3 plus 350. Like, I mean, yeah, it's a decent bit, but it's not like compared to the fact that we could lose $10 million. It ain't cutting it. So we are going to seek to get that term debt paid down as soon as possible, and we're going to seek to have the backing of a sponsor that if anything does go wrong, they can put some money in the company, or perhaps pay down the term debt that we're not secured on, that we have an airball on, I should say. And that kind of leads me to an ECF covenant, which is an excess cash flow covenant, and I'll talk about that in a moment. But these deals are often difficult to get approved by credit, and then additionally they are leveraged loans. Leveraged loans being loans that are meet a regulatory standard to be considered leveraged, and they receive a lot of scrutiny. So naturally, it's going to be hard to do for a bank. Moving over to covenants. Covenants allow the bank to limit the borrower from putting the bank in potentially a negative position. We are going to try to make them so they do something, yet they're not too restrictive to keep the company from generating profits and growing. We really want to provide some efficient markers that aren't going to jeopardize the company's ability to grow. There's a variety of covenants. Some of them are very basic, like reporting requirements. Then they move over to leverage, liquidity, and even limitations to the amount you can distribute. So an FCCR or FCCR is going to be, your bread and butter, or like FCCR, current ratio, and debt to equity are my key financial metrics that I'm putting on almost every deal, which is I'm going to say, all right, an FCCR is similar to a DSCR, but I'm taking into account the capital expenditures associated with the company, because obviously a company is going to have to constantly, reinvest in buying equipment so they can continue to generate steady profitability, and I really want to take that into effect when I'm, setting when I'm thinking about the credit risk of a company. So I'm going to use FCCR, I want a minimum FCCR of 1, maybe 1.2. I want a minimum current ratio of 1. And then I want a maximum debt to equity, if I'm defining it to liabilities to equity, of 3 or 4, depending on what I'm doing. And then additionally, there's going to be reporting requirements that I'm setting as a covenant, which is going to be an audit. I'm going to say, hey, you're going to give me an audit, and then you're going to have 120 days after, the end of the year to provide me with that fiscal year audit. And then there's ECF covenants on M&A transactions. So their ECF covenant is an excess cash flow covenant, which basically says every dollar after that one times level of FCCR, or not every dollar, but half the dollars after that, one times FCCR are going to go down to pay down some of the term debt associated with your private equity deal, or maybe not your private equity deal, but the deal in general, if it's a non-sponsor backed M&A deal. The reason we're going to do this is because, as I mentioned earlier, there's often an error ball associated in M&A transactions, which is that shortfall between the credit outstanding and the underlying collateral. And I want to go ahead and remove that shortfall as quickly as I possibly can, because that's going to de-risk my deal. And then we have syndications. Syndications are really attractive for any bank. And specifically, you're going to want to be the administrative agent in a bank. There's many other titles. Whether you're the left lead, right lead, you're the JLA, whatever you are, the administrative agent is going to be the biggest winner in any syndication. Administrative agents are typically the big balance sheet banks. The reason this happens is because, if I have a $500 million deal, and I have a big bank offering to put 150 million in, I'm going to go with them, because if they're putting in 150, it limits the amount of banks I have to work with, which is going to be attractive. Then additionally, administrative agents, because they're the big banks, often have very robust capital markets teams that could do DCM if they ever want it, if they're ever wanting to do like a bond offering. So there's that natural ability to cross-sell that product, and the clients are really going to appreciate that they can have a lot of their main capital market functions at one bank. But the reason why syndications are so attractive is fee income. You should know in your career that there's nothing banks love more, and that Wall Street loves more, than fee income. And it's real simple. Basically, in fee income, like imagine I'm doing a $100 million loan. I need $100 million to loan that out. But if I'm doing a $100 million loan and I could charge a 2% fee on top of it, there's no more assets I need to provide to charge that 2% fee. Like, it's just an additional income, which is obviously going to be very attractive, because your return on investment for the amount of $100 million you're putting in is going up. But syndication fees can vary a lot between deals. You could do a flooring plan for a car dealership, and you're charging a 20 bip fee or a 0.2% fee. But then you have a large private equity deal that's going through it 5 times senior debt to EBITDA, and you're charging 2.5% on, $300 million credit facility. And, the bank's getting rich. So naturally, those are going to be the very attractive deals to do. And so a lot of people are going to target private equity transactions at a commercial bank. And you should know in your career that the deals you should be chasing, or the deals you're going to want to be chasing, is maybe not the deals you should be chasing, but are the deals that are going to be the most profitable for the bank. You should think, what's going to make the bank the most amount of money, because then in return, you're going to be making the most amount of money. But going back to syndications, there's multiple factors, industry and leverage. Some industries are considered high risk, and higher risk industries are going to command a larger syndication. Syndications will often go oversubscribed. So you may think you're getting $50 million to participate in the syndication, but it turns out everyone that got shown the deal wanted to be part of the deal. And now you're only getting 30 million. And so you just got 20 million cut off the table. And that's honestly fairly typical. But as a participant, syndications can often be challenging to win, because the administrative bank is going to do their best to keep all the fees and all the deposits to themselves. And you're going to tell the client and the bank, hey, this is not going to work for us if we are not getting a percentage of the deposits. Like, we want pro rata share deposits, and then we want the ability to also win some of the treasury management deal. So it could be, we want the credit cards, we want the merchant processing, or we want the management's, maybe wealth management account. So that's a lot of things to think about in commercial banking. But hopefully this video was somewhat helpful, and I hope you appreciated it. Thank you so much.